Hey, how's it going, everybody? Welcome to Finance with Avrin. In this video, I want to tell you about 5 ways the federal rate cuts could affect you. And for the past year, you've been hearing about it. You've been seeing it on the news. The rate cuts are coming. The rate cuts are coming. When are they going to come? Okay, how much is it going to be? 25 basis points, 50 basis points. Okay, it's going to be June. It's going to be July. Oh, no, September for sure. Yes, September is when it happened today, September 18th, 2024, 50 basis points. A lot of people were thinking 25 for the past couple of years. The Fed was raising rates. You see it just going up a little bit, and they just kind of let it stagnate for a while, see how the economy handles it, and now they started the cuts. Now, here are 5 ways that the federal rate cuts could affect you, not just this one rate cut, but the scenario, the realm, the predicament we're in of the Federal Reserve cutting rates and possibly continuing to do so. Now, this isn't in any kind of certain order or anything, and I have the video bookmarked and organized into chapters if you want to skip to a certain section or go back to a certain section or however you want to do it. And let's get into it here. One of the ways the federal rate cuts could affect you is by lowering mortgage rates. When the Federal Reserve cuts interest rates, it typically results in lower interest rates on mortgages. If you've been in the market or you're a realtor or you're in that realm of business, you possibly started to see that already happening earlier this year, in the middle of the year for sure. Things get kind of priced in, just kind of how stocks price in data and news before it kind of happens. That happens sometimes with yields as well when it comes to the Federal Reserve rate. Now, this could benefit families and people looking to buy a home by lowering the monthly payments, making home ownership more accessible, because the slightest movements in mortgage rates, 1%, 2% or so forth, it affects monthly rates a lot. You see it here on the screen. You see how a slight change in your interest rate could affect your monthly payments just like that. This could be like a decision whether or not somebody would be able to afford a home. How much can you afford monthly? You don't want to get in over your head. Some people do that, and hey, I'm not going to give you my financial advice on that. There's a certain amount of your income you should be having going towards your mortgage. So there's certain amount percentages if you want to, stand around being financially secure and stable and financial freedom, this kind of things where you should not go in over your head basically on your housing costs and the car costs and all that kind of things, for sure. But yeah, these rate cuts could make home ownership more accessible for sure. A drop in mortgage rates from like 4% to 3% could significantly reduce the total cost of borrowing over a 30-year loan. Like you see it right there, examples on the screen. Slightest movement in rates could definitely affect your monthly payments and the overall mortgage amount, because when you have that mortgage on a house, 15-year, 30-year, whatever the amount of the house, you've got a $300,000 house, $400,000 house, $500,000 house, you're not just paying that amount. With all that interest and everything going on, that amount of that house price could double basically. When it's all said and done, like if you paid all your monthly payments every month, everything like that, after that 15 years or 30 years, you paid more than that initial sale price of that house. But now that percentage of that actual mortgage loan amount could definitely change that, where you're paying even more or even less. Now, the lower rates may also enable homeowners to purchase a more expensive house or afford a larger down payment and strain their finances less. Now, you've been looking for houses in the past year. You had a cap on how much of a house you could afford because of the interest rate. Now, with the interest rates being lower and going down, that monthly payment amount would be lower. So, hey, you could possibly look for those houses with the higher price tag on them. And in the past several years, fixed rate mortgages have become more attractive compared to variable rate options. So this would definitely affect fixed rate mortgages, because when it comes to fixed and variable, it's the same with mortgage rates as it is with like yields. A fixed rate is going to stay that same rate for the term of the loan. A variable yield could change throughout the term of the loan. So when you're locking in that rate, you'll know for sure what that amount is with a fixed rate. Whereas with a variable rate, yeah, in this scenario with rates going down, a variable rate may be something people may consider, but who knows if things reverse course. If, inflation went crazy, or if the employment numbers went crazy, then the Fed would reverse course and, start raising rates. And then you're sitting there looking at your mortgage rate just increasing. I personally like to have a fixed rate when it comes to mortgages, to know exactly like, okay, this is going to be my rate. These are going to be my payments every month until possibly, I refinance. That's something that can be on people's radar now as well, with mortgage rates going down, with the Federal Reserve rate going down. It's possibly refinancing. So like, you get in a mortgage now, or you got in a mortgage last year or something, and then the rates start coming down and you think like, oh, okay, let me wait a little bit. Let me see. Okay, this could be a good time to refinance. This is a possibility that could be in your hands now with the Federal Reserve cutting the interest rate. And when it comes to like refinancing, for example, a homeowner with a $300,000 mortgage at a 5% rate might save hundreds of dollars per month by refinancing at a 3.5% rate. So that difference of 1.5% could mean hundreds of dollars saved per month on that loan payment. And so that refinancing could free up disposable income that could be used for saving, investments, or debt repayment. Though now the positive of that, of course, you have significant savings with your monthly payment, improved cash flow. However, the negative of that is that there are refinancing costs associated with refinancing, which could offset your savings unless you carefully calculate it. So just because the rate went down some doesn't automatically mean, you should probably just, hey, go refinance real quick. Do the numbers, crunch the numbers, talk to your loan officer, somebody who's in that realm, somebody in real estate. See if it's worth it for you to actually refinance your loan. Maybe you should wait it out a little longer, be a little bit more patient. Maybe right now is a good time for you. It depends on your rate, what it was before, and what you can get now, or next month, or next year, or so forth. Now, there is a negative impact that could happen in regards to lower mortgage rates. Now, lower mortgage rates could possibly drive up competition in the housing market, which has already been hot for the past several years real estate in general is just a hot market. It's a great investment, I would say. When people say, what should I invest in? Or if I'm talking to somebody about investing and just financial freedom, security, two things I tell them to invest in for sure. Or stocks, ETFs, exchange traded funds, the market in general, the stock market, and then also real estate. Those two realms right there are like it. And then, of course, entrepreneurship. You could definitely get ahead with entrepreneurship. But yeah, the negative with lower mortgage rates is that potentially driving up home prices with that competition increasing, because you're going to have more people getting into the housing market. Maybe you're, looking to buy, but you've been sitting on the sidelines for the past year. You're not the only one. There's several other people in that same boat who are just maybe gave up, were looking for a house, and maybe, kind of got priced out of some because of the interest rates and things, and the housing prices keep going up, because that's just something, as you see on the screen, home prices continue to go up. So I say it's a great investment, real estate. But yeah, so you see that going up, but then you get, with these lower mortgage rates now possibly going on, you have more people getting back into the home market, which could drive up home prices, because then you have bidding wars. You have people bidding higher amounts on houses, and you have people selling houses going like, hey, there's way more buyers in the market. I can list this house for higher and it's probably going to sell, So that's one of the cons definitely associated with lower mortgage rates. So yeah, there's some pros with it for sure, but then there's that con right there. So yeah, that is one way that the Federal Reserve cutting rates could affect you, is by lowering mortgage rates. And another way the Fed rate cuts could possibly affect you is by cheaper credit. A Fed rate cut usually results in lower interest rates on various forms of consumer debt, such as credit cards, personal loans, and auto loans. For families and individuals, this could translate into less interest paid over time on borrowed funds. For example, if a credit card rate drops from 15% to 12%, somebody carrying $5,000 balance would have a significantly less on interest charges. That 3% difference right there is way less on that debt that you could be carrying. Now, of course, what I would like to say is, don't carry debt, especially credit card debt. Rates on credit cards could definitely eat you up. I like to tell people like, hey, try to pay off that debt every month if you can. Don't leave a balance hanging around on the credit card, because those rates around 20%, even with them lowering possibly to, low 20s or 18, 17%, 12%, that's still a high rate to be paying, interest on debt on thousands of dollars, hundreds of dollars, even thousands of dollars, tens of thousands of dollars. So yeah, I won't keep jumping in that because I will go down that rabbit hole. But yeah, lowering rates of the Fed could result into lowering rates of borrowing costs, which could be essential to somebody. You could be in the market for a car, an auto, and then now you possibly have a lower rate going on with your auto loan. Have your good credit score going on. Definitely keep your credit score up, because having a great credit score is going to help you get the best loan rate out there. That's one thing that could go hurt against you. Now, rates could be coming down, but you can have a horrible credit score and you're still going to get stuck with pretty bad rate. Now, if you have a great credit score, you've been working on it, or you're going to work on it now, and you're out trying to get a loan, you're going to have, a lower rate on that loan because of the Federal Reserve cutting rates, which also lowers rates typically of borrowing costs like personal loans, credit cards, and car loans. Now, one way this could possibly negatively affect you is that if you start seeing these rates come down on borrowing and you think to yourself, oh, I can buy more now. Now, that is the thing that can slip you up and mess you up. You see the rate go down on your credit card. You go, oh, swipe, 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 or you see the rates going down. Oh, maybe I'll get that car now. Maybe you don't need that car. Maybe, that's the thing. Even though something is cheaper to buy from borrowing, doesn't mean that you necessarily need to do it. Now, if you're in the market already for a car, in the market for, something that you're going to swipe on the credit card and then pay off maybe, or something like that, then yeah, this could benefit you. That's good. Let's go for it. Sure. But if you're just buying just because of the lower cost of something, overspending, over accumulating, then that's just going to lead to more debt, and that can get you in trouble. So yeah, that is the negative part of this that could possibly affect you. And so those are two ways right there that the Fed rate cut could affect you. Here's another way Another way that the Fed rate could affect you is by lowering saving account yields. And now if you've been subscribed to my channel, checking out my savings account videos, then you're already aware of this. You already see this because I do videos every other month on the top 10 savings accounts ranked by APY. And something that's been happening this year are that yields have been coming down slowly in little increments for some savings accounts because, like I told you at the beginning of the video, things started to get priced in basically before they happen. And some of the banks know pretty much, hey, the Fed's going to cut rates later this year. Well, maybe I'll start lowering that yield on our savings account a little bit to get ready for it. That way we're not just doing it all at once. Or maybe by that time we'll lower it some more. We've already lowered it some. We'll lower it some more when that happens. So yeah, that's already started to happen in savings accounts and CD accounts, or that yields have started to come down some. And I do videos every other month on the top 5 CD accounts ranked by APY. And you can see that in those videos as well. I'll even show, what a previous yield was for an account, a month or so ago and what it is now on the list, or even if it got knocked out of the top 5 or top 5 list because of that yield lowering. And also I have a whole video on the federal funds rate versus and compared to the savings and CD account rates that goes into detail about the correlation between those and the history of it. If you want to know more about that, check out the link in the description for that video. Now, for people out there that are relying on the interest from their savings account or their CD accounts to continue funding their emergency fund or setting up another emergency fund or short-term goals or even living off the interest, this could be a setback for you for sure. A high yield savings account that once offered, 5% APY could drop by 0.5% to offer that 4.5% or 1% to offer 4%. And I've already seen it out there happening. Accounts have been lowered 0.15% here or there, 0.25% here or there. So yes, it's been happening in those increments. And so those drops in the APYs and interest rates could significantly reduce passive income from those savings accounts and CD accounts. Now, this could possibly drive people to invest more. Now, if you've been doing both, like me, been investing, but also adding money to CD accounts and savings accounts, now this could maybe make you lean more towards stocks, which on average have a better return than savings accounts and CD accounts. On average, overall stock market S&P 500 has a rate of return of around, 8 to 10%. I'm seeing 9 to 12%, things like that, around that amount, which is going to be higher even than a high yield savings account at the peak of the Fed rate heights, which is around, 5.50%, 5.75%, things like that. I'm not sure. I had to look back at my videos to see what the highest amount I've seen, but it was up there around that amount. And there are still some up around that amount. The last video I did of the top 10 savings accounts ranked by APY for September 2024, all of the accounts in the top 10 were over 5%. And the honorable mentions that I talked about in that video were at 5%. So yeah, there's still definitely accounts out there around and above 5%. But even with that high amount, the market in general typically makes more than that over the average. And so you see that dollar amount going up each month of interest that you've been accumulating and compounding. Now, you start seeing that go down some. You may say, well, I'm not going to keep adding that $100 a month or that $100 every 2 weeks to this account. So it could discourage you. So is there positive of that? Maybe you're going to look more into investing in the stock market, which could lead to higher returns. Negative of that is that adding less money to your, of course, savings accounts and CD accounts could be discouraging for your passive income that you were getting. And then also maybe you didn't even have your account to that certain amount that you wanted it at. And now that's going to discourage you, going to take you longer to get there because you're not putting as much money into that. And then the amount that you were getting from that yield every month is going to be less because that yield's going to be lower. So positive and negative of that. But one thing that you could do to even lock in a yield at this amount right here, if there's a certain CD account out there you like by a certain bank and you see that term length and you can see the yield and you have a lump sum of money that you don't need to touch, you can lock in that high APY, that high yielded interest rate with that CD account for that certain term amount, whether it be 6 months, a year or whatever amount. And then you'll know pretty much how much money you're going to get from interest from that lump sum of money you put in there. No matter where the yield goes next month, 2 months from now, you'll have that yield locked in at that certain amount. So even if it goes down, then you'll still have that high yield, whatever you had it locked in at, for the whole length of the CD. And I have a video all about CD accounts explained with pros and cons. I'll leave a link down to that video in the description if you want to check that out too. Now, that was a kind of negative way that the federal funds rate could affect you. Another way that they could possibly negatively affect you and me is through the possibility of increased inflation. Now, the Fed rate cuts could lead to economic growth and activity by making, borrowing cheaper, which can encourage people to spend more and spend more. But what that's going to do possibly is lead to inflation. So if the economy overheats, inflation may rise again, which would lead to higher prices for goods and services. Now, inflation. I know you've seen it the past couple of years. We've definitely been dealing with it and paying for it. in many ways, inflation. And some of it's been sticky, so it's still around. It's still sticking to us. You see, gas prices, I've seen those go down some, still high, I think. But grocery prices, I've definitely noticed those go up. And I still continue to see, like, yeah, those are still pretty high. Like the bill that I'm getting from the grocery store is still pretty high considering the few bags that I have when I'm walking out. And so, of course, inflation, what that's going to do is that's going to take a hit to your purchasing power when it comes to, groceries, housing, healthcare. When prices go up on things and your wages are the same, then, it's just costing you more to afford things that you were buying at a certain price, last month or last year. So your dollar is not becoming more, valuable. The money in your bank account, that $100 is $100 unless it's earning interest or invested or something like that. That $100 is worth $100. Now something that say costs $100 now it goes up because of inflation to $110. Well, you still just have that $100 just because the cost, the price of that item went up from $100 to $110 doesn't mean that $100 bill in your hand became a $100 bill and a $10 bill. So yeah, your purchasing power will take a hit when inflation has gone up, like it already has in the past couple of years that you've noticed. So a rate cut could spur inflation to pick back up because that short-term boost in consumer spending and business growth could possibly lead to that. So that is something to possibly prepare for. Even though inflation is somewhat cooled, as the data has shown, as Jerome Powell and the Federal Reserve have been talking about, there's a possibility that it could pick back up with increased economic activity. On the other side of that, which could be a good thing, that could affect you. Economic activity increasing, business growth increasing, all of that happening in the economy, that could boost the job market. Now, one of the goals the Federal Reserve often has with lowering the interest rate is to stimulate economic growth, which could lead to job creation and potentially higher wages. So like I was saying previously, if your wage stays the same and the price of items are going up, that's not good, of course. But if your wage is going up and the price of items are going up, then, it kind of offsets that. So individuals and families out there may benefit from that stronger job market with more opportunities for employment. If you've been looking for a job, maybe, that job is going to open up now. If you've been looking for career growth, opportunities in your career, that could possibly open up now. Job transitions, maybe that's going to be more readily available to you now. With businesses expanding themselves, maybe they're opening up another office over here or adding new positions to this department and so forth and so forth. Wage growth could also happen if businesses, and with those businesses is expanding and looking for more increased skilled workers, that may lead to wage growth because, they got to pay people more. If somebody's going to stick around, they're going to want more. If you want to attract better employees, you often have to pay more. Or if you want to attract employees in general, sometimes you have to pay more, no matter if they're better employees or not, just to get people in the door. You got to, hey, this place over here pays this. Well, we got to pay more than that because we need people to come work for us. So that could definitely happen. So increased economic activity could lead to a positive of, greater job stability. If your businesses, wherever you're working at is growing and everything, they're likely going, if you're doing a great job, keep you around. Your job has become more stable because, the business is making more money. Wherever you're at is generating more economic activity. So if you're doing a great job, hey, we got to keep this person around. They're helping us out. So increased job stability. Also possibly wage increases. Hey, this person's doing a great job helping us, but we also maybe need to pay them more so they stay here. So yeah, that could be a wage increase right there happening because of increased economic activity. Now, of course, the negative side of that possibly is that if inflation outpaces wage growth, then, the gains would be not as great as they are because, okay, maybe you're getting paid a little bit more, but inflation's just running up way more than that. Or maybe you're not getting paid that much more and inflation's just running up. So economic activity increasing has its good side and its not so good side. All right, everybody, and that is it for the video. I hope this breakdown of how the Fed rate cut could possibly affect you gave you some useful insights, whether it's saving on loans, investing in the market, saving money, managing rising prices. Staying informed is a key to making smart financial decisions and becoming financially stable and educated. If you found this video helpful, don't forget to hit the like button and subscribe to the channel for more tips on managing your money, financial education, and navigating this world of finance. Let me know in the comments how you feel about the Fed rate cut and how it has affected you, or if you have any questions. Hope you enjoyed the video. Take care.